I've been getting a lot of questions around dividend stocks as we could potentially have lower interest rates in the future, as highlighted by Jerome Powell. He said the time has come for policy to adjust. So a lot of you asked me, what are the best dividend stocks, the best REITs to be buying to bet on lower interest rates? Because interest rates are gonna come down, the yield's gonna look more attractive, and you could make a lot of money and all these things. And that sounds pretty amazing. It sounds smart. But I'm going to be honest with you guys. And if you're trying to buy the REITs or you're buying popular dividend stocks, if you're not a dividend investor, you're just trying to bet on lower interest rates, it's likely not going to work out. Even though interest rates could come down. But now it became consensus. It became well known. Jerome Powell admitted that interest rates are going to come down. Now, that doesn't mean that these stocks can't keep going up, but you have more downside than upside with a lot of them. And this bet has been available for months, and we talked about it on YouTube. But people told me, yeah, dividend stocks are boring. And I told you guys the return on these stocks are not going to be boring at all once they start playing out. And VC is up 12% over the last 6 months. Realty Income is up 17%. Coke is up 16%. ADC is up 29%. And BTI, the value trap British American tobacco that everyone hates, is up 21.5% over the last 6 months, and most of the gains actually started from June. So it's been a pretty wild run. But I do have two stocks for you guys. If you're trying to bet on lower interest rates, or if you're trying to be a dividend investors, these are two stocks that are still somewhat flying under the radar, that a lot of investors haven't really paid attention to them. The first one is an amazing quality company with very high margins. A lot of you are gonna love it. The second one is a dividend stock, but it's extremely hated and people love to hate on it, call it value traps. They love to bash the name. But I'm still seeing value in the stock. So I'm going to discuss both of them, and I really hope you enjoy it. The first one is called CME, which is CME Group. It's only up 1.5% on the year. A lot of you have likely heard of CME, especially if you trade future contracts, or maybe you've seen it on some indices or many different things. CME is a very popular one, especially amongst professional retail investors. And they do a lot of things, but mainly within future contracts, within interest rates, betting on SOFR, Fed funds, US Treasury, on futures of equity indexes, S&P and Nasdaq Russell, on FX, on crude oil, Henry Hub future contracts, soybean, a lot of agriculture stuff, commodities, precious metals. So mainly within future contracts, and they have other instruments too, but future contracts, this is where they have a moat. This is where they have an edge, and there's really not much competition in this area for them. And it's going to pay out handsomely well, especially in the future, as their largest one has been interest rates. And we've been having a lot of volatility in interest rates, and interest rates are going to continue to be volatile into the future. You're going to have a lot of volatility, a lot of changes in the economy, lower interest rates, a lot of traders, they want to bet on it, they want to hedge against it, they want to do something about it. If they want to do something about it, they likely have to buy or sell a CME interest rate swap or future contract. And this is what this company has, and they have an amazing moat, competitive advantage, and it's very popular, good reputation in this industry. But you're not only getting a company that you could benefit from on lower interest rate, you're also getting a good company in general. And this is not their only business. They have a second business which is called, mainly data components, or you could say data sharing. So they do sell the data to other kind of brokers and many different things. So they could have CME on their websites, or maybe to professional investors. And this is a higher margin area for them. It's been growing 10% CAGR. And it's pretty good. In terms of competition, I told you they don't have much competition, but they do have one, which recently got approved, and they've been competing against them mainly with lower prices. And this is called BGC Group. Maybe you never heard of it, but the stock has been on fire. It's up 42% year to date. It's still only a $4.7 billion company. So it's not going to take over CME tomorrow, but this is the first time I start to experience some competition. But I still have a moat, a competitive advantage, a first mover advantage for decades in this industry, and it's not going away anytime soon. Now, you're not only getting all that stuff, but you could also get an amazing catalyst, which a lot of people aren't paying attention to, and it's mainly Robinhood, which they're trying to push in future contracts for retail investors. And I'm being honest, guys, I hope this never happens, because this is stuff for professional investors. And a lot of things could go wrong, especially within deliveries, crude oil. I mean, it could go really bad. This is not options, this is not playing games, this is not sports betting, this is serious stuff, and it could cause a lot of damage. and it's more speculative than anything you could ever find in your life. So I hope it never happens. But this is what they're trying to do. They want to incentivize people to trade. That's why they have 24 hours trading. People cannot wait to open a position 9 a.m., or 9:30 when the market opens. And that's how it's been. And it might happen. If it does happen, CME Group is gonna do amazingly well in this area because they have a monopoly within future contract. And if it does happen, as I said, it's just gonna be amazing. This company has amazing net income margins, pretty close to 60%. 60% net income margin. This is higher than any of your favorite tech stocks, even Visa. Visa has 56% net income margin, and this company has 60% net income margin. So it's extremely, extremely profitable. You look at the dividend isn't the highest ever, but it's at a 4.6% dividend, which is not bad at all. And this dividend has been rapidly growing from $2.80 in 2018 to $9.65. Very rapid dividend growth. And they're likely going to continue to increase the dividend because they don't do a lot of share repurchases. So you're getting all this stuff. You're getting a company with a dividend, which is going to look attractive when interest rates come down. But you're also getting the company that professional investors use to bet on lower interest rates. You're getting pretty much a double engine kind of stuff. It's pretty amazing. And then you don't always get that stuff. But you're not only getting all these things, you're getting a company that's trading at a fair multiple, in my opinion, especially on a historical average, trading at 21 times. Forward PE, the mean was 25. It traded as high as 34 times earnings. And as we're entering a volatile period at 21 times earnings, in my opinion, is going to end up being cheap for CME. Now, the problem with CME is because they benefit from volatility, their earnings growth are a little bit unpredictable. They expect 1.7% next year, then 4%, then 6%, and it's all over the place. But in my opinion, with interest rates and all the volatility, it's likely going to be much, much higher than 1.7%. So you're getting an amazing company with a good balance sheet, a very good management, some kind of a moat, competitive advantage in this industry, and it's pretty good, very high margins. You do have a dividend 4.5%, and it's a direct way for investors to bet on lower interest rates, and you're getting pretty decent earnings per share growth, 2, 3, 4%. Not the best ever. For me personally, if I had to buy a dividend stock here or to bet on interest rates in general, I would be considering CME Group. I think CME Group stock is a buy, and it's one of the few stocks where you could actually bet on lower interest rates. You could benefit from it from many different ways, but the market has yet to catch up. The stock has bottomed, it started to go up, but not as high as it should, especially as it's trading at 21 times earnings, which is near a bottom. The lowest was 18.5, and now trading at 21. So I like CME here very, very much for many different reasons, short term, long term. I think it's good for both stuff, and I do like it. Now, this is the second one, which a lot of you are going to hate and get comments all over the stock. It's mainly Verizon. And I talked about this stock a lot, especially when it was trading much, much lower. The yield was like 8.5%, and people were saying it's a value trap. I'm like, come on, guys. Now it's yielding 6.5%, but it's still, in my opinion, a good value proposition, especially relative to other dividend stocks or REITs or opportunities in the stock market. Verizon trading at $41, $41.45, down 28% over the last 5 years. If you look at the last earnings report, it wasn't the best. They barely grew on revenues, and they declined 5% in EPS, although they had some one-time expenses, but they still declined 5%. Now, if you want to invest in Verizon, you have to look at the free cash flow. And the free cash flow went from 8 billion to 8.5 billion. And this is the main story with Verizon that a lot of investors are not understanding. The company went through a very heavy CapEx kind of cycle, or CapEx heavy cycle. And now we're investing in a lot of new stuff. And those investments are nearing the end. So what's happening is this CapEx is coming down from 23 billion to 18.7, now 17.2. It's likely going to stabilize around 17.2 billion. Now, as CapEx is coming down, free cash flow is starting to move up from $14 billion to 18.7 this year, expected 19.2 next year, and up to $20.7 billion by 2027. Also, I wouldn't count on it, but I would count around $19 billion in free cash flow. And this free cash flow will not only allow them to sustain the dividend, but also pay down some debt. And the dividend right now is 6.5%, still much higher than what it used to be at in the 4 and 4.5. It went as high as 8% or 8.7. and now it's trading at 6.5% dividend, which is a very good dividend in general. The company will sustain a dividend, as I said, because it's paying out around $11 billion a year. And if they get $19 billion in free cash flow, that would leave them with around $8 billion to do buybacks if they wanted to, or even to pay down the debt. And this is the main argument that's why people hate Verizon, because they look at the data on Yahoo Finance. They don't look at the details. They look at the data on Yahoo Finance. They see total debt, like, I don't know, like 200 billion. Now, with every stock, and sometimes it's just lease liabilities, and lease liabilities were not even on the balance sheet before 2018. So sometimes you have to look a little bit deeper. But if you look at the long-term debt of Verizon, it's $140 billion. That's a lot of debt, no doubt about it. It's a lot of debt, and they shouldn't have taken so much debt. But having said that, Verizon, in my opinion, would be dumb for not taking on a lot of debt, because they have such a predictable business model. And this is what you have to understand. If the company has a predictable business model, they would be stupid not to take on a lot of debt and increase return on equity and create more value to shareholders, because they do have the predictability in free cash flow for them to pay it off, and they do have the balance sheet, and they do have the credit rating for them to refinance it. And this is what this company does. And this is why when I talked about a stock before called CSV, they're in funeral homes. I mean, that's really sad stuff, but this is recurring revenue. Like, it happens every single year. That's just how it is. And the company was operating with a lot of debt. And people told me, it's a trash company, they have a lot of debt. And they would be dumb not to be taking debt. If I was them, I would be taking a lot of debt. Same with Verizon. Verizon would be dumb for not taking on a lot of debt. But the debt is humongous at $140 billion. And I hope they're going to start to pay it off. They did pay 3.5, but they need to pay a little bit more. And they do have some maturities due in the near term, which is $12.2 billion for 2024, $17.7 for 25, and $10.5 for 2026. Now, if you remember, after the dividend, they only have $8 billion left, which is not enough for them to pay the maturities. But this is why these companies have good credit rating and they refinance. And this is how they also benefit from lower interest rates. So you don't only benefit from lower interest rates because the dividend is going to look more attractive, but the company itself will benefit because they can refinance that stuff at more predictable interest rates. And that's going to help the company very, very much. And now the free cash flow yield is 11.4%. which is what I would expect in terms of annual returns on Verizon. But the mean was between 8, 8.5, sometimes as low as 6%, 6.4% on a free cash flow yield. But it's around 7 to 8% on average. Now it's 11.4%. If we have lower interest rates, I wouldn't be surprised if the free cash flow yield comes down. So for me personally, maybe Verizon isn't the best, but for the dividend and relative to other opportunities, I'm seeing value in the stock, especially with the CapEx cycle and the free cash flow cycle for the company. My favorite is definitely CME Group. If I had to bet on lower interest rates, I would be considering CME and Verizon. And this is just my opinion on these two stocks, not financial advice. Thank you for watching. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.